equity is entering a new era shaped by AI, higher capital costs, evolving LP expectations, and a more complex environment. In this PE Forum interview, Mark Vassallo, a managing partner at Lightyear Capital, shares his perspective on how Lightyear is navigating this shift through its focus on financial services and healthcare investing, long-term value creation, and disciplined growth strategies across changing market cycles. Mark, thank you so much for joining us today.
Well, thank you very much for having me.
So you've built the identity of the firm around financial services investing. What is about, if I can use the term, financial plumbing businesses that consistently creates better risk-adjusted returns than more visible consumer-facing opportunities within your investment thesis?
Well, I think if you look hard enough and you have the experience and talent, I believe you can find opportunities in really any industry. And I think private equity in general over a long period of time have demonstrated that. Over our 25 years, I've come to understand that there's really a time and place for practically any company to succeed. It's just in some cases it may not be for very long. And people think financial services is inherently a cyclical industry because I think they conflate it with the stock market. But if you look at long periods of time, financial services is a secular growth industry. Just look at consumer investable assets, look at institutional assets, look at the growth in payments, look at retirement assets, and even look at the stock market over long periods of time. All of these things have grown nicely over a long period of time.
And so it is not just the generic investment thesis, it's really digging into it and knowing what is happening.
Yes, absolutely. Yeah, and being a deep domain expert in a field where you can really take that knowledge and compound it over time to not only source good investments, but to work with companies to grow them.
You're also heavily invested in healthcare services and technology. I mean, if we look at it at the first glance, it's difficult to understand the link with the financial services. So could you please explain to our audience, what investment logic bridges between financial services as you see it and healthcare within your investment thesis, and why it is, in your view, a natural expansion?
First of all, we look at healthcare through a financial services lens, and I'll get into that a little bit more. We're not looking at drug companies and medical devices. We look at it through a financial services lens. Individuals have to deal with 4 long-term challenges in their lives. I mean, buying a home, educating their children, retirement, and healthcare. And our financial lives are very intertwined with our daily lives. And individuals, these are big challenges for individuals, and they typically grow. The expenses in these areas grow faster than inflation, and they also grow faster than the government's ability to subsidize them. So individuals need solutions, and there's a vast opportunity to help solve these growing problems. And within healthcare specifically, that may mean for us studying products and services that help to reduce the cost of healthcare expenses for individuals or for businesses. And healthcare is such a big and growing part of the industry, of the economy, that obviously payments is also a big area for us within healthcare.
If we continue on this line of thought, whether it's in healthcare or in financial services, is there a single most important signal that tells you, well, this company can actually scale?
The first and foremost for me at least, it's the size and growth rate of the market in which the company competes. Is there a tailwind for this company? Do you have to grow by taking market share from someone else, or can you just grow based on growing with the market? These are two vastly different scenarios for any management team. So having the wind in your sails, to me at least, is extremely important. It's easier to manage a business in a growth industry.
You recently closed a 2.8 billion fundraise. Could you tell us within this environment that we're going through, uh, how did you come, how do you think about the size of the fund, and what does that imply for the type of and volume of deals that you're going to look for in the future?
It is about $1 billion, larger than our prior fund, and we've always taken a very disciplined approach to the size of our funds. Really, it's an exercise of measuring it against the opportunities that we see along our various themes. And over the decades, the other two factors that have developed is, first, most companies driven by the stock market have grown a lot over time. So companies, in general, are much bigger than when we founded the firm 25 years ago. Multiples are up, the economy's strong, so businesses that we used to buy for X are now, are now just bigger. Second, I think that our brand and our reputation built over this 25 years has really opened up a larger set of opportunities for us, and including some larger opportunities. And so, as we have raised Fund 6, as you say, I mean, we've already committed about 40% of the fund and are ahead of our pace for investing. So, at the moment, we don't really see any issues in deploying our increased size of our capital.
Do you look into balancing your portfolio of companies within the segments that we mentioned, or does it go deeper? And also geographically, how do you map this out?
We're principally focused on U.S. domestic businesses, and we are cognizant of trying to develop a diversified portfolio. We do have 10 to 14 investments per fund, so it's relatively concentrated versus someone who's got maybe 30 investments. We're getting very involved with those companies, and we are cognizant of developing a well-rounded portfolio. We've got 5, 6 themes, and we've got teams around each of those themes, and they're all expected to contribute to the sourcing and the investments during a typical investment period.
And do you personally have a favorite theme? They say don't fall in love with a theme, but is there a theme that you particularly appreciate or like to look into?
Well, I started my career in wealth management, and so I've always had a love of wealth management. I think, as I said earlier, there is a real need for people to be able to save and invest for all of these challenges that they have, and it's an important thing. And if we can help by providing financial advice and services to help them meet their goals, then you can do well and do good at the same time.
If we continue on this idea of two platforms, let's say you have a financial infrastructure platform in front of you and a dominant healthcare infrastructure platform as well, what fundamentally would drive the decision to choose one of these two?
I think it harkens back to what I said earlier. I think the attractiveness of the market segment in which the company operates comes first. I don't want to take away at all from the attractiveness of partnering with the right management teams, because analyzing that is critical as well. I used to say that we're in the investment business, and we're actually not in the investment business as much as we're in the people business, the talent business. Marrying good talent with good companies. A talented management team can manage practically through any market, address any opportunity and any challenge. So if you happen to get the market wrong, management's critical for helping you get through it.
Before we move on into the broader private equity environment, and we're going to start discussing the impact of AI on the investments, do you use AI in your due diligence, in supporting your operations, in supporting your portfolio companies?
Years ago, we started looking at AI and all the applications. We've got an AI czar here at Lightyear that's responsible for making sure that we're driving adoption of AI products and services within the investment team. We also have AI operating partners who work with us in the portfolio companies to generate ideas and products and services at the portfolio company level. It's all still in the early, the baseball analogy would be the third inning of where AI is and what it can do. But we're very much proponents of embracing the opportunity to make our own business and our businesses operate better.
You mentioned the stock market, and there's been a impact from AI on SaaS companies and different software companies as well. How do you look at it? Do you see it more as an opportunity, or is it more worrying for certain portfolio companies? How do you approach it?
I think you've got to look at it clearly as an opportunity. I mean, this is AI. This is not by any stretch of the imagination the first time that businesses and the economy have been threatened by new disruptive technology. Historically, technological advances have generally led to bigger and better businesses and more employment as more opportunities unfold. When not everybody remembers because they're not as old as I am, but when the internet started, there were dire predictions everywhere about industries and companies that would go bust. All retail stores, banks, car dealerships, etc. Every one of those would be disrupted by the internet. Everybody would buy everything on the internet, even books. That today there are more independent bookstores in America than before the internet was created. Why? Because they adapted. They all have internet solutions as part of their business model, and so new businesses get created, other businesses benefit. So we're very much focused on how can we use AI to drive making our companies even better. I think whether it's creating products and generating revenue, or in most cases driving efficiencies and driving margins higher.
And LPs in general, do you feel today that they're worried more about the evolution of AI, or let's say about the geopolitical situation? What comes up first?
They view the political situation as shorter term than the change in AI. So, and they tend to, by definition, they're long-term investors. So I think they're thinking more about the impact of AI over time, and that's something that we talk to them about quite a bit and try to showcase what we are doing in AI.
The LP relationship also has changed, and the structure has also changed beyond just regular and plain vanilla commitments. I would say now there's the co-investments, separate accounts, the fee structures have changed. How do you approach that, and how do you continue to have this strong LP engagement?
We haven't really had to adopt our fund structure or our model to meet those demands. We've been working with co-investors really since day one, and we really value them in our investments. They can add to the thinking. They can offer a different perspective. A growing number of our investors, high percentage today, want access to co-investments, whether it's to reduce their overall expenses on their investment portfolio, or to partner with a strategic value add partner like ourselves. I think it's something that has changed because more and more investors are seeking co-investment, but I think that's fine for us. It really creates a closer bond with our organization too, because if they invest with us, they get to see us in action. They also can sit on our boards, and it creates a relationship not only with me and whoever is at the company, but all the way through the organization here at different levels. So it's in general been a good thing.
And in the markets where you invest, which you mentioned, you look at first the market that you want a market that is growing. This also attracts more competition, and so within the specific verticals, is there a segment that you feel is really heating up with competition?
I think there's more competition in general, and I think we're feeling it in for the first is in price. I think you can see valuations pretty much across the board that have been higher, and and I think one of the reasons is there's just more competition. Just the simple concept that if you have more people around an opportunity, there's a higher probability that the price is you're going to get it as a seller, you're going to get a better valuation. So, in our case, we have to be comfortable with paying a potentially higher competitive price. And our philosophy is the way you win is to really pick your spots and focus and have conviction around an industry and companies in that industry. You don't want to be a tourist at all, and there has to be a couple things in place really before you buy anything. One would be a well-developed sense of what to do with the business once you do own it. Two would be a well-developed relationship with the management team, and three would be a well-developed set of relevant experiences and people that can help in that space. So, these take years to develop, and we benefit by being deep domain experts and doing this for 25 years and having really good depth and knowledge on what questions to ask, how to add value to the business, and we can differentiate ourselves in a process. Can we buy things cheaper? Sometimes, but not often. Often we have to be the highest price, and therefore you have to have all these things in place. And being an educated consumer is much better than being a tourist.
If let's say across the board valuation become too high, can you stop and just wait, or what do you do? What's the strategy then?
We've done that in the past. Of course, part of the diversification is diversity over time as well as by industry. You don't want to necessarily, wait around for 2 years for valuations to get better. They certainly haven't in a long time. So you've got to kind of dollar cost average your way through a fund as well. Also, it's at least my view that if you are a domain expert like we are, you can more likely generate proprietary deals. Again, if you're a well-educated consumer, and we've certainly been able to do that. And I define proprietary deals as there's no banker involved. You develop the relationship, and over a long period of time, and if finally they finally want to sell, and that's we've been a beneficiary of that.
Bigger competition, but on the other hand, exits are changing. I mean, IPOs are no longer the only way. Even industry buyers are no longer the other way, and we're seeing an increase maturity in the secondary buyouts and continuation vehicles. Has that changed when you do an investment and how you perceive up to where you want to take the company you invest in?
think we always ask questions about what's the potential exit strategy. But on the other hand, we don't beat it to death. Our philosophy is if you can buy a good business and you can make it much better, participating in a healthy, growing market, there's always going to be an exit opportunity. People like to buy good, well-run companies in growth areas. So I think if you can do that, then you're in reasonable shape. Timing sometimes matters, and size sometimes matters. So you do have to think about exit planning throughout your ownership, and be willing, if the timing is right, to quickly pivot and take take advantage of what you see as a market opportunity, consolidation, or there are a lot of people around that would be interested in your company, and not just hold it for the sake of holding it and getting maybe a better return in the future. And secondly, as companies get bigger, not having an IPO market in particular can be a real concern, because as you get into the billions and billions of dollars of company value, it's just harder to find a good, healthy number of potential buyers. And that's where I think our middle market focus really helps, is that we aren't owning companies that we have to get a consortium of private equity players to buy, typically.
Conversation with the secondary market investors, they tend to push the idea that there's a lot of companies that are overvalued. They mention, zombie companies. Do you see this as a, pressure trying to be put forward, or do you see indeed that there's a lot of companies that are held in the market that, should be priced down?
I have been calling for a correction in the market for many years now, and been wrong. I do think that we are in the process of a market repricing. There over the last couple of years, we have heard more and more companies that have tried to sell but decided not to, because they might have gotten bids that were not acceptable to them. So they decided that they would hold it. I think that's a sign that there's a repricing going on, and that I do feel that prices will get better. Obviously, DPI has been a big issue within the industry. Investors haven't gotten all their capital back, and that's created a big supply, and so something will have to give in there. I do feel like private equity firms, us included, have to execute on these businesses. They're worth what they're worth, and just because some deal team thinks that they're worth a lot more doesn't necessarily mean that that's the case. So I do feel like it's a very good I think it's going to be a very good environment for buyers over the next couple of years, because I do think there's a lot of pent up supply that needs to be pushed out, and I think M&A will grow.
And you would prefer, when you do these acquisition, to buy from a family, or are you open to buy from another PE firm?
I think that we're pretty much indifferent to who's selling the business. I mean, we've bought businesses from founders, we've bought businesses from private equity firms, and we've done a fair amount of divestitures where we're buying we're buying subsidiaries of big financial services firms that need to divest a business, and we've had success in all three. So we've bought and sold 60 businesses in the last 25 years, so we've got a lot of collective experience with all those sellers. So I'd say we're fairly indifferent. We do have a differentiation in having bought many businesses from financial services firms that want to divest, and those in general, for us at least, have gone well.
And if we take the point of continuation vehicle, do you see this as an opportunity also for you to use in the future?
Well, I think that's been one thing that has allowed private equity firms to return capital to investors and meet the DPI kind of concerns that our investors have, and I think that obviously. I think there was 100 billion of continuation vehicles last year. I think it is an attractive outlet. We've done one continuation vehicle. I think, in general, I think we would typically sell to another private equity firm or strategic than look at continuation vehicles. But they've been a good outlet for private equity firms that have needed liquidity, and there are circumstances where that might be the right exit, particularly if you're trying to clean up an old fund and you've got a bunch of cats and dogs in there and you want to put it into a continuation vehicle. That might make some sense, but we don't have lots of experience on continuation vehicles.
You mentioned the market correction that might happen. How do you think this would impact funds that have heavily relied on financial engineering through leverage? Do you see that there could be a systemic risk?
Leverage for us is we really try to avoid high leverage. We driving leverage can absolutely drive higher returns, and for us, we don't run our companies at high leverage. We generally take less leverage than what's offered to us in a deal. We've had experiences, particularly in our earlier days in our first decade, where over leverage became a problem, and just living through that is very damaging. I mean, everyone focuses on the short term, the daily revenue. No one's thinking long term. All the strategies put on hold. You lose a bunch of time. It creates a lot of stress. So we try to avoid that by having relatively low leverage. I think in terms of a future problem, I mean, the leverage that depends a lot on the leverage terms and what actually happens if someone trips up a covenant. It doesn't necessarily mean bankruptcy. I mean, there's a lot you can do. There's a lot of flexibility, and so the industry. I mean, there are a lot of smart people in this industry, and they can adapt and figure out a way to get through all that. And there's, as I said, there's tons of capital. So if people need assistance and they need other investors, there's capital there.
I'd like to move now to your personal experience and your investment philosophy. You mentioned the years that you shaped the vision for Lightyear, went through a lot of crises, and they say that evaluating risk is a key component of any good investor. So I'd like to know, through all the experience that you went through, whether it's early ones with post-COVID and before that, the financial crisis, has it changed, or what has shaped the way you evaluate risk?
The first thing that comes to mind is really expect the unexpected and plan for the worst. And as I said earlier, I have for the last couple of years been thinking about when's the next correction, when's the next down market, and there hasn't been one. If you do that, if you plan for the worst, you are pretty much by definition prepared for any outcome. And it's a lot of work, but it generally pays off, and you get better at it and more efficient over time. So everybody makes mistakes, and the key is to learn from them and try not to make the same mistake twice. But I think expect the unexpected and plan for the worst can help you get through get through that.
Is there a belief that you had about investing, whether it's, on the sector or about risk, as you mentioned, or about value creation that has completely changed across time that is no longer valid today?
In the very early years of Lightyear, decades ago, I think we thought that perhaps buying balance sheet financial services businesses, specialty finance, non-bank banks, insurance, underwriting businesses, somehow provided insulation in an investment and risk modification because the assets on the books would generate ongoing revenue. People businesses, on the other hand, the old adage was, if it's a people business, your assets go up and down in the elevator every day, and they could also leave. So that created a different risk. I think over time we've come to appreciate that the opposite is true. We've come to the opposite conclusion, which is, balance sheet businesses, because they tend to be inherently leveraged internally, they can produce outsized returns, but also they can produce, mammoth blowups too. And so the range of outcomes is just greater. And whereas asset light businesses in the right segments, as I said, with the right management teams, can produce more consistent and repeatable returns. And that's basically our experience over time. And we've had very good. We have a terrific long-term track record, 25% IRRs over 25 years. But within that, there's some variability, and I would say the last 15 years, much more consistent, repeatable returns as we focused more on these asset light businesses than in the earlier days, where our overall headline return would be very good, but there'd be more variability there.
In your view, what matters most in private equity is to exactly have the thesis right from the beginning, or is the capacity and the willingness to shift around after you've done the acquisition?
I would say both, but if you had to really pin me down, I think it's really about what you do with the company once you own it, and particularly in today's environment where, decades ago you could create value at the closing, you buy it right, some financial engineering, you're already up, 1.5, 2 times, and there's a lot more competition today. Prices are higher, and so value creation during the time that you own it has become much more important. That means driving revenue growth and driving margin expansion. So one thing we've done is focus a lot more on that, and we've also built out a broad group of industry operating partners and other domain experts who can work with our teams on the sourcing, evaluation, value creation, and the whole picture of making companies more valuable.
Is there, let's say, a signature deal for you like this? If you could, walk us through an experience where, whether it's a negotiation or whether transformation that you achieved within the company?
Oh, there's lots of examples of that. I mean, most of our companies, we often feel like, years later, like, why did we sell it? Because the things doing so well. But basically, I mean, we're buying businesses that typically need a lot of foundational support. So they need a fully functioning finance system. They need probably a bunch of new CFO, CHRO. I mean, there's so many C's today, but they need a built-out management team. They need a strategy or a more refined strategy. They need to develop KPIs. They need to think about how they can attract and retain clients better. And so it's a fair amount of blocking and tackling, and that's, I think, something that we do really, really well. So, for example, on divestitures, which I said we had kind of a differentiation, and all our divestitures, knock on wood, have done well over time. That's partially because we're taking kind of a part company, and it's not fully formed, not fully functioning. We're taking it and putting it out on its own. We have to build it out, and honestly, they're generally, at least in our experience, they've been generally undermanaged. And so there's a fair amount of uplift. I think about when we bought Clarion from ING Group, if we bought Advisor Group from AIG, those just working with the talent that's there, adding to it, getting them to think differently about the business, and working with them more as a partner than an employee-employer relationship has really blossomed into bigger and bigger companies. When we bought Cerity Partners from the bank here in New York, I mean, it was multiples smaller than it is today. Today, it's a huge, really successful company. So I think that's been it's kind of the basic blocking and tackling that has really helped these companies take off with good and smart management teams.
So does the DNA or the culture you instilled within Lightyear trickle down or goes through to your portfolio companies, and it's something that helps them?
I hope so. I hope they would say that. I mean, we certainly try. We try to be a strategic value add partner and ask good questions and help them. And when there are problems, we're right in the boat with them, trying to solve the problems, not just complaining. So I do hope that comes through and is part of our culture and reputation.
Beyond investing, you sit on the board of schools, the St. Mark's School, to mention this one. Why is this important to you?
Two reasons. One is to learn, and one is to teach. So on the teaching front, I have been fortunate to learn a lot in my life, and if I can offer that knowledge to others who can benefit from it, then I feel like that's the right thing to do. So that's the teaching part. On selfish part is I learn in the process as well, and so exposure to people that have different perspectives and different priorities, it makes you, I think, a better person, and appreciating diverse ideas from people who don't think like you do has helped me in my own job. And so I really think it can make you a better investor.
About the learning, there's also in many conversation the idea of having a mentor or being a mentor. Is this something that you lived through your career?
Certainly. I worked with my mentor for 29 years until he died, and he going back to before we founded Lightyear Capital, and that's been very important to me. And for me, we have a very, very intensive mentorship program here. I have my own mentorship program with people here where I try to mentor as many people here who want to be mentored by me, and I have a whole program. And it's something that's I think very, very important to spend the time. We're in a people business, and the younger generations all want to learn. I mean, this is not like in my generation, people gave me stuff to do and I did it and I handed it to them. That's not the case today. Everybody, the younger generation wants to learn. They want to understand what they're doing in the context of the whole, and it's all very good. But they are benefiting from mentorship more than I did in my early years, I think mentorship's critical.
If you had to give one rule or one advice to a person that you're going to mentor, what would it be?
Try to get things down to one side of one sheet of paper. There are people who are very good at expanding data and giving you 100 pages model and 40-page decks and things like that. But if you can get it down to one side of one sheet of paper, then you've really mastered a tremendous skill, and it's partially a skill to save people time, and because not everybody can get through 90-page decks and 40-page investment committee, and it challenges you to get to the essence of what's going on. That'd be my, and that's the, ask anybody here, they'll tell you that's the advice.
And and about going on the ground, we have, we're living in a time where everything is behind the screen. Do you still think that it's important to go on the ground and meet the people, or you think that everything can be done, via screens today?
Old fashioned. I think being a personal touch is very important. I think getting people in the office, engaging, having board meetings in person. Not every board meeting, but board meetings in person. We ask management teams to come to our investment committee to meet in person with us, and then you can do something social with them as well, or we go there to do something with them socially. Yeah, I am not I think there's a lot of efficiency in doing Zoom meetings, but it doesn't really replace the learning that you can get and the culture that you can build with people being together.
Agreed. Mark, thank you so much for your time.
Well, thank you very much.